What's up, Bitcoin people? Hope you're staying safe out there. It's your boy, Colin. I'm here with Christian. What's up, Christian?
How's it going, man? Just getting through another day. Bitcoin's pumping.
Yeah, dude. Bitcoin is pumping. It's pumping with stocks, though, so it makes me less happy. But I'm always happy when Bitcoin's pumping. I'm also pumped because I think we just recorded a really bomb episode. We sat down with Ansel Lindner, host of Bitcoin and Markets. Really cool dude, just has a lot of theories and ideas on macro financial markets and the economy. And we talked a lot about Bitcoin, obviously, as always, but more so we talked about Fed monetary policy and the risks of deflation and how Ansel, thinks that the real risk here, guys, is not hyperinflation, but actually deflation. So really excited to show you the show, but before, got to handle the sponsor biz. First up is Swan Bitcoin. Swan Bitcoin is a sexy way to stack sats. It's got really seamless dollar cost averaging features, available in 49 states, lowest fees on the market, great service. Highly recommend you go check them out, swanbitcoin.com.
We got every way you can buy Bitcoin here. Next is eToro. So Swan Bitcoin's all about dollar cost averaging, and eToro is all about trading. They make it easy for you to trade the way that you want. You can buy Bitcoin. You can buy other shit coins. We do not recommend that. But if you want it, you got it. And if you want to do index fund investing, if you want to actively trade, if you want to passively actively trade, with their social trading features and copy trading features, eToro is the spot to do that. Go to eToro.com, check them out.
Or if you want to stack sats and be liberated at the same time, you can hit up Bisq for the best and really the only way to trade Bitcoin in a decentralized manner, unless you're literally just like going to one of your homies and paying cash. Bisq is a decentralized order book that allows you to buy Bitcoin worldwide using a variety of different features like Zelle, even money orders, things like that. And you download your own instance, run it over Tor, trade in a decentralized environment with Bitcoiners all around the world. Check it out, Bisq.com. Like I said, really probably the only true way to trade Bitcoin online in a decentralized fashion.
And last but not least, Colin, me, and the entire Bitcoin Magazine team are hard at work planning the ultimate halving party. We have a 21-hour live stream broadcast from Bitcoin Magazine with all of your favorite Bitcoiners talking Bitcoin the entire day leading up to the halving, and capped off with a massive virtual halving party. Again, every Bitcoiner that you know is going to be there, including Ansel, including Pierre Richard, Bitstein, Marty, and Matt D'Souza. If you know them, they're going to be there. Check out bitcoinhalving.com. We got less than 20 days until the third ever halving. Be a part of history. Go to bitcoinhalving.com. Yeah, and let's just get into this interview. I think Colin said everything you need to hear at the beginning. Ansel is just bringing the unpopular opinions. Everyone is screaming inflation, and Ansel is doing the hard work to understand why deflation, the opposite, could be possible. So yeah, let's just jump into it.
What's up, y'all? Welcome to What the Fuck is Happening with the Fed. I'm your host, Colin Harper, and today I'm delighted to be joined by Ansel Lindner, self-proclaimed Bitcoiner. We love it. And also the host of the Bitcoin and Markets podcast. Ansel, how you doing?
I'm doing great, Colin. Thanks for having me on.
Yeah, man, definitely, brother. So you staying locked down over there in Jacksonville. What have people been doing? Has there been, in Tennessee and Kentucky, the prevailing sentiment is kind of civil unrest. People are tired of being locked down and they want to get back to work. What's going on over there?
I mean, especially in my area, I live in a little self-contained little bubble, and hasn't been too bad. I mean, now we're about 75% of people are wearing masks. Lots of businesses are closed down, but my world is not extremely affected. So that's a good thing.
Yeah, that is a good thing. I'm kind of finding that with me as well. I kind of feel like I'm in a bubble. Used to be a seedier part of Nashville, but my girlfriend she babysits for a few families, and she's had steady employment because all the parents are working from home and, need a babysitter. And I've had some consistent work with writing, and we're doing podcasts like this. So It's been kind of nice. I feel like I'm waiting for the other shoe to drop, though, which is kind of making me feeling anxious. But yeah, people are clamoring to get the economy opened back up, man. I've been having arguments with my dad about it because, like, I understand the argument. Obviously, you can't just say, oh, well, if you open it back up, people will die. Well, it's like, yeah, well, people's lives are going to get worse if the economy doesn't open back up, right? But if you open the economy back up, then maybe people get sick and the economy closes. It's a terrible dilemma, and it has horrible consequences that we've seen this week with oil futures for May just bottoming down, just plummeting, and people asking. I remember I told my dad, I said, "Yo, oil prices went negative," and he goes, "No, what?" Like, his response was just like complete, like, "What do you mean?" And so we have a lot of stuff slated for the show today. I think that kind of to get it kicked off, a few things. Oil bottomed out this week. Stocks are climbing. 4.4 million unemployment. Ansel, what's going on right now? What's the macro view?
Depends on how deep you want to go on it. It kind of problem started around 2018 into 2019. And then this virus, I think, was just a big catalyst. So it condensed like the next 5 years of economic problems down to 3 months. So that's kind of where I see this playing out in a grand scheme. Now, I could go into some of the problems we saw prior to this virus and then why I think the government is cracking down the way it is. But that's a long conversation, but we could go there if you wanted to.
You're saying we saw some weakness in things like, the repo market in September. Yeah. And you're probably going to even go so far as to talk about some weaknesses that were showing up in 2018 when we started to try to wind down QE3, right? Because that's really when you started to see some of the problems, and then there were liquidity constraints because of stuff that was implemented with the Dodd-Frank Act. And it was kind of this horrible concoction of like regulation and also just mismanagement as usual. But I guess just give us a key breakdown in your view, like the key points of instability that kind of set the stage for what we're experiencing right now.
Yeah, well, it's really hard to know exactly what's wrong. One of the problems with shadow banking is you don't really have good statistics about anything that's happening, but you can get glimpses from certain things you can see, like NERP. When NERP started really taking over in Europe, that was a key sign.
Break that down for some of our listeners. What is NERP?
NERP is the negative interest rate policy. So when interest rates basically were below zero, I think out to 30 years in Germany and in Europe. So that's just showing like for some reason everybody wants to buy treasuries or bonds, and that's a bad sign. Germany also slid into recession. We saw the Italian financial crisis stuff in 2018, Brexit. I mean, just populism and the feeling of unrest around the world. In 2019, we saw Chinese bank failures pick up, Chinese debt. I mean, I think China was going to be the epicenter of this, even if it wasn't a virus thing. I think China was going to be the epicenter financially as well. And on the Fed side, we saw in 2018, we saw inflation expectations turn down. And then we saw the quantitative tightening stop. And we saw rate cuts then in 2019, and finally followed by this repo instability. So, this was just building. This was coming to a head, and the virus,
yeah, and
like
that's
I said,
one of the
just
things.
Boom. Yeah.
That's one of the things that I think is most frustrating, especially when you look at mainstream media, is the idea that it's so easy to play this narrative. And I often find it frustrating when any media outlet says stock does blank on blank news. It's like the stocks aren't. Yeah. I mean, sure, stocks will react to these things, but that kind of media framing creates narratives that are hard to eschew at that point because the populace buys into them. For instance, one of those narratives being that this was some sort of black swan, that, COVID's toppling the financial and economic, well-being of this country, like no doubt ravaging the economy. But the financial markets were in a bad spot before this happened. And you were kind of touching on it there when the Fed started tightening, that quantitative tightening and started, trying to shrink its balance sheet. When they started trying to do that, we found out in 2019 that whether by combination of malfeasance, regulatory requirements, or just, all of it, the liquidity is not there. And we're starting to see what happens when you start ramping up that balance sheet, and then you start saying, oh, well, now it's time to deflate it. Well, it's really hard to do. And then people don't realize that in practice, we've never really, this in practice isn't as set as it is in theory, or as surefire as it is in theory that some people think it is. And so I really like that you're hitting on that point, and I think it can't be overstated. COVID definitely accelerated something that was a long time coming. You also touched on negative interest rates there. We have some T-bills in the States, right? Is it like, what is it, the 15 or the 30 year, or it went negative for a time, right?
The very short dated bonds, like 1 month to 3 month, I think actually did go negative here recently. But for the most part, that's US. But for the most part, it's US has been positive. The big thing also was the interest rate curve inverted. So the shorter dated bonds were paying more than the longer dated bonds. So that's another sign. If you go back in history, every time that happens, a recession follows within 6 months or something like that. So
yeah, and explain to our listeners why it kind of almost sounds absurd. People, the money printer go brr meme is becoming kind of ingrained in the social conscience. And they see that, but then they see also the headlines that say traders around the world just want dollars. There's this flight of liquidity to dollars, and that even as the dollar gets printed ad infinitum, people still want it. And you often hear in financial talk and financial media, why do people stomach negative rates on treasury bills? In Germany and Europe, also the short-term ones in the United States, because they want the security and they want the liquidity guarantees from the Fed. So can you kind of explain that to our listeners, why people want these treasury bills, even though sometimes they pay out negative rates because of the liquidity guarantees they provide?
The U.S. rates didn't really go negative except for a very brief time, just recently. But in Europe, they had long-term negative rates now. And the reason for that, I believe, is because they want those for collateral. So there's a dearth of high-quality collateral in the system. The way I kind of think of it is the repo market or the Eurodollar market is the consensus layer. That's the base layer of the monetary system. And to interact with that, you need collateral. So if the collateral is being sucked up by quantitative easing, so the ECB doing quantitative easing, then there's no good collateral to go into the repo markets to get cash. So there's a huge demand for treasuries or bunds or Japanese government bonds. So that's why the rates are stubbornly negative, because people need that collateral to access the cash in the repo market. This is a collateral problem. Everyone's saying it's a liquidity problem, but there's $2 trillion of reserves sitting at the Fed. There's no cash shortage in that respect. There's a cash shortage because businesses don't have collateral to go into the repo market to get the cash that way. The flow is stopping. It's a flow problem.
Right, and this is why the Fed is starting to buy all sorts of junk bonds and things like that, so that people can finally use what's sitting on their balance sheets that they can't use, that they wouldn't be able to use as a collateral otherwise, that they now can. And on this note, I kind of want to jump into that. The idea of the Fed continuing to expand its balance sheet, and not just expand its balance sheet, but expand the things that it'll buy. I was listening to a podcast this morning, Joe Weisenthal and Tracy Alloway's podcast for Bloomberg. I can't remember the title of it right now. It's evading me. But they had Nathan Tankus on, who's this kind of independent MMT researcher, and just this kind of encyclopedia on what the Fed's doing. And one thing that they kind of talked about, one of the questions they asked him was is the Fed kind of stretching its mandate? And of course, Bitcoiners would say yes, and Austrians would say yes, that they have for a while. And they talked about the blending of fiscal and monetary policy. But another thing that they asked him was, what about some of this debt that they're buying? People always say, oh, it's just, there's moral hazard, it's just junk bonds. And Nathan was saying, it's not always bad, but some of the stuff, these corporate bonds that the Fed is buying, it can be dangerous, because who knows if what they're buying has any value. I want to kind of jump into that side of the Fed's monetary policy and kind of get your take on, the stuff that the Fed is buying these days. What kind of risk does it carry? Why are they having to buy it? What's going on now that the Fed is setting up these facilities for the secondary market and stuff?
It goes back to the collateral, that the collateral isn't good enough to entice the liquidity providers, the natural liquidity providers in the market. So this would be big banks with all those reserves sitting on their balance sheet at the Fed. The collateral is not good enough to entice those guys to provide liquidity in the market. So the Fed is coming in and saying, we will provide that liquidity. They're artificially creating, trying to simulate this flow. It's kind of like I said, the consensus layer. If you have blocks stopping, then it doesn't matter what's going on necessarily in layer 2 or layer 3 or whatever, because the consensus layer is stopped. So when the natural repo market is frozen and the Fed has to come in, that's like no blocks being produced. So right now there's no repo blocks being produced in the world naturally, because the collateral is not good enough to entice people to lend. There's plenty of cash on the balance sheets of these big banks. I'm not worried about the solvency right now of U.S. banks. Now, foreign banks, maybe, yeah, but not U.S. banks.
And you're saying you're not worried about the solvency. Is that in part because of some of those regulations that were implemented, like the Dodd-Frank, the regulations they used to supplement what they took from Glass-Steagall?
I'm not an expert on those things. I see the excess
You just look at the balance sheets?
Yeah, the excess reserves sitting at the Fed. It's going to be, I have the chart up here. Let me see what it is right now. It's 2.5 trillion, and it's probably going to get up to 4 trillion here soon. And that's liquidity that could be lent in the repo market, but it's not being lent because there's no good collateral. And so the flow of the economy is freezing up. And that's why I say that it's going to be going into.
And just to clarify, those are Fed accounts for big banks.
Yes, that's big banks, or it could be U.S. banks or foreign banks too, can have a Fed.
But just to clarify for listeners, that's not the Federal Reserve. Like, that's not their money. That's J.P. Morgan's, that's Goldman Sachs, that's Citigroup, that's Deutsche Bank. And one thing that I think is important to point out here too, just kind of tying all this together, there's no good collateral out there to support short-term loans in the repo market, so that to boost lending and spending, because quite frankly, no one's willing to take the risk on shitty collateral, and no one is willing to post shitty collateral for the interest rates that were being offered, for instance, in September, which were like 10% in the repo market. The Fed had to step in to provide liquidity to drive those interest rates down. And this is an important point, I think, for listeners, is that's what all the Fed's market operations ultimately seek to do. And Ansel, correct me if I'm stepping out of line, is they're wanting to drive interest rates. Why would you go to banks that are charging you 10% when the Fed's offering 0%? And what this also does, and we can kind of dabble in here because I think it fits with some of your theories on, inflation and all of that kind of stuff. But, this fucks with price discovery. Because if banks aren't willing to lend money to an institution because their collateral is not good, then that should tell you something. But right now, the Fed's offering basically indiscriminate loans to anyone who has something that's worth posting on their balance sheet.
Let's talk about collateral for a second, because a debt-based money system incentivizes money printing. And for the consensus layer, the repo market, to function, it needs collateral. And so these banks, or the people that want to access the money markets, they invent exotic collateral. That's why we saw the MBSs, and now we see I don't want to cut in here really quickly. I'm very happy you're hitting on this, because this is something I don't think the average American realizes, that a lot of financial instruments on Wall Street are debt repackaged into more debt, and sold and just passed from bank to bank. Yeah, and the reason why they're doing that is to extend the ability to inflate more, right? But eventually, it has its own. It's a ticking time bomb, so it has its own end in sight. So when the collateral gets too exotic and too fragile, and some people start not accepting it in the repo market, that's when you see a big freeze, like we saw in September and what we saw in 2008. So it's the natural progression to search out new collateral for this repo market. And that's why I think a lot of this is actually negative. What the Fed is doing, they're not helping the situation at all. Even what their crazy plans are, they are taking good collateral out of the system. Not only like the government bonds through QE, but now all these other programs are taking all the marginal collateral out too. So again, it comes back to there's just no collateral for the consensus layer to keep going, and it's going to freeze up.
Right, and we're starting to see the pipes freeze already, which is why the Fed has to turn on the burner, and Rush to turn on the spigot.
That leads to deflation, though, because if the music stops, there's going to be massive defaults everywhere, and that is a hyper deflationary event.
So let's unpack that a little bit, because people hear words like deflation and inflation thrown around a lot. So give the people a quick, 2-sentence rundown of a good definition for deflation.
Deflation is a contraction in the money supply. Inflation is an expansion of the money supply. Those both have corresponding price movements. So an expansion of the money supply inevitably leads to inflation somewhere. And a contraction of the money supply inevitably leads to price decreases. And we're seeing that everywhere. Every commodity, has been in a 2-3 year bear market now. Government or oil, that's a great example. What happened in the oil market? That's, going negative. You can't get much lower than it went. So all prices are dropping, and that is a sign of money being destroyed. It's a deflationary event. The monetary base is being pulled back right now through these defaults.
And can you explain why it's being pulled in from these defaults? People their loans are getting called in, they can't pay it, and so their spending power is basically obliterated.
Right, and so when money is created by banks making loans, and if you can't pay that money back and you default, then that money is now destroyed again. So it's created in the loan process and it's destroyed in a default process or in a paying off. You can't even pay off the debt, because paying off the debt actually destroys that money too. It's a slower, more controlled way of doing it, but that's what this debt money is based on. It's based on expansion and contraction. And right now, that's why I don't think there is inflation out there. I don't think the money supply is expanding. I think all of these defaults are way, way too much for anything that the Fed is doing, anything the U.S. government's doing. Money is going to continue to be destroyed, and that's deflationary.
But some of our listeners might ask, how can we be in a deflationary economy if the Fed is printing trillions? And what would you say to that?
Well,
factoring in the fact that a lot of the wealth that has been created in the past 10 years, with people taking out loans to buy assets like homes, a lot of that will soon be destroyed, especially in the next few months as we start to see more defaults, as more people struggle to pay their mortgages because of coronavirus. But anyway, continue.
Yeah, there's some really big markets out there, like the U.S. Treasury market, the Eurodollar market, repo markets. There's FX markets and derivatives. There's $1 quadrillion worth of derivatives alone. And then all of these other markets are probably quadrillions more on top of that. And so when you see these like $200 billion bailouts from the government or whatever, that's a drop in the bucket.
Yeah,
it's like trying to
in the bucket.
Yeah, it's trying to hold, the dam is breaking and you have a little metal bucket trying to help. No, it's not going to work. It's the deflation. You have to, they would have to do a $10 trillion package just to see any sort of difference in my mind. So that's kind of how I explain it.
So when do we get the inflation that Bitcoiners are always clamoring for? I won't say we're clamoring for it, but we're rather kind of, prophesying that it's going to happen.
I don't know if we do. I think the CBDC stuff that we're seeing is an attempt to go MMT.
So can you give us the name behind the acronym and explain?
So yeah, CBDC. I think that's the thing behind these CBDCs, which is central bank digital currencies. There are many different central banks around the world are actively pursuing this new technology. It's kind of like a ugly stepchild of Bitcoin in a way. Then they're trying to use this as a new government currency, and they're trying to find some sort of new collateral or some sort of new money that they can use because they have a feeling that this whole system is coming down. So I don't know if, eventually maybe, 20, 30, 40 years out, we might see some inflation, but I don't see any inflation near term. It's not coming. One reason why gold is going up, I think, is because people are looking for collateral, and gold is good collateral. It's right up there with U.S. Treasuries. So there's demand as collateral, not demand in inflation, but demand as being collateral. And Bitcoin needs to jump on that train. I think that this is a huge opening for Bitcoin to become seen as pristine collateral in a way. So I hope over the next 12 months or so, we start seeing some companies or something happening on that front to really get in there as being pristine collateral.
Yeah, so I think that's a good kind of segue for us to kind of jump into another topic on our list. We've already kind of gone over one, right? Concept of debt money, right? And obviously Bitcoiners know what fiat money is. But maybe we can just run through some of your, theses and your insights on, differences between commodity money, debt money, and fiat money. And because kind of what you were just saying right there, we could have a commodity money again with something like backed by Bitcoin and gold.
Yeah. So there are big differences between debt, fiat, and commodity monies. Commodity is easy to explain, right? Every Bitcoiner knows that. Fiat money, though, is it's money created that doesn't have a corresponding debt to it. And this is where MMT goes down this road. So right now we have a debt-based system where when new money is created, there's a corresponding debt or financial product that's also created. And so that's the difference between pure fiat and pure debt money is the backing, what else is created along with that money. During Bretton Woods, we had a combination. So there was debt because it was fractional reserve, but there was also fiat because it was legal tender, and there was commodity behind it. It was all pegged to gold through the US dollar. Right now on the Eurodollar standard, we have pretty much a pure debt system. So it's all based on debt. The way that, and I don't think people really appreciate how much different that system is to the end game. So the end game for a fiat money that is not backed by debt or commodity, that is hyperinflation. That's where we see all these hyperinflations in history. A commodity money can have some inflationary cycles, but there's no deflation because every ounce of gold is still there. So if you have a gold standard or a Bitcoin standard, you might get some inflation, but then in the bust, the boom and the bust, in the bust, there's no destruction of the money supply because there's still the same ounces of gold there. But in a debt-based system, you have inflation and deflation. And this deflationary cycle is what many people don't understand because they're comparing it to like pure fiat money that's not backed by debt or commodity money. So I think that's where most people kind of trip up in understanding the system we have right now is debt can deflate. Nothing else will deflate. This is the only type of money that has this built-in deflation on the backside.
Well, theoretically, couldn't fiat money deflate, right? I don't see any reason why a money that has the same risk profile in some regards as debt-based money where, it's not necessarily tethered to anything that has, for lack of a better term, intrinsic value, right? Like you could still theoretically get deflation because, money could still be destroyed in that system, right?
I guess it could, yeah, in some respects, but as a global monetary base, there's nothing to deflate. It's all just, I mean, they could deflate it by taking, go ahead.
It's like trying to deflate air, I guess. Right?
Yeah,
like there's just so much of it already, and the monetary base is already supreme and like, under complete control of, the government that controls it, that I guess, changes in supply, it just absorbs that change basically. Right?
Yeah.
Like the sovereign issuer just absorbs that change in the money supply. So it's not really created or destroyed.
Yeah. They can try to cause some deflation by raising taxes in a total fiat MMT world or modern monetary theory world.
And just completely pull that money out of the monetary base.
Yeah. They can try
basically
to do that.
Like a token burn.
Yeah, exactly. That's exactly what it is. But most of the time, the way they get deflation in those systems is they just take zeros off. So instead of everything costing 1,000 units, it just costs 10 units. They just cut the zeros off.
It's really incredible because, like, I think when you Google MMT or like people talk about it, it seems like this absolute like leviathan of a monetary system that's very hard to approach. And it's really complex and abstruse and involves all of these crazy monetary and fiscal maneuvers. But at the end of the day, it's literally as simple as just taking dollars and cents off of a balance sheet. I mean, that's an oversimplification for what happens now. But I'm really interested kind of circle back to something we were talking about previously. The once central bank digital currencies do exist, and they will exist. They're coming and they'll be everywhere. And you're able to open up a direct line with your central bank. That's my next question. Don't you open up the floodgates for inflation at that point? Because then, I think Nick Carter has argued this. Bailouts have lost their weight. Like I remember when I was young when the financial crisis of 07, 08, 09 was going on, but I remember the word bailout being like a very foreign term. I was obviously a kid, but it sounded scary. Like, oh wow, that's a big deal. It does no longer hold its weight. We've made money cheap, and everyone expects everyone expects cash from the Federal Reserve, and UBI will eventually become the standard. I think once some central bank digital currencies are entrenched. So all that to say, now that the precedent's been broken, and it's kind of just like, yeah, we'll give people money for any crisis. Do you see inflation? Do you see if the government continues to kind of respond to every crisis by throwing money at it, do you see inflation as a possibility in a shorter time horizon than you'd originally said?
No, I don't think so. Because I believe bailouts are money replacements. The money is being destroyed behind the scenes, and these bailouts are just trying to, stem the tide of the deflation. We just, like I said, look at prices around stock market prices are fake. We can kind of talk about that, but the commodities prices everywhere, even wages and stuff, real wages are flat or down over the last 30 years. So I see that the inflation is just not there in the economy. So the reason why the repo market freezes up is because nobody wants to take that collateral. It's an estimation on the liquidity provider, the bank with the reserves. They look at the person that's trying to give them collateral for money, and they don't trust them, right? And so the original time that we did bailouts, then it shifted. It had an effect on the entire psyche of the market, and they felt more confident about it. And so they were willing to unfreeze the market and start lending again and flow this money around. But as we get more and more used to bailouts, that doesn't help their confidence. It almost works the opposite way. And so bailouts kind of now signal that things are going to be really bad. So don't lend that money. Stop the flow of cash. So yeah, it's a diminishing returns, and I think we're at the end of the road that way. So that's why the Fed has to come in through the entire market.
All right, so you don't see inflation in the short term or the near term. To kind of get back on this topic, can you explain one more time how we're seeing deflation in the market currently with defaults and the destruction of the money in the monetary base?
when with debt money, it's created when you make a loan. And when you default on that loan, that money is destroyed. Now, what we see in the repo market and in money markets in general is these customers, not the primary dealers that are the big banks that are doing that have a lot of the different collaterals, but some of the smaller players that are needing that capital, that they're needing the liquidity, but they don't have direct access to it. So they're trying to get access to the money markets to pay off their debt or to service their debt. But they can't, because whatever collateral that they have to offer is no good. And so nobody is going to lend to them. And that's why the Fed is coming in and providing those direct payments for them to service their debt. So there is no deflation, or there's less deflation. But on a bigger scheme, many businesses are hurting. Many businesses can't make payroll. Many businesses are going, just closing their doors. And so the entire monetary system is having this big default cycle. It's so gigantic. I think it's 500 trillion you would need to plug this hole. And so anything that the Fed is doing right now is not enough to keep the monetary base even level. It's not inflationary because the money supply is still decreasing faster than anything the Fed is pumping in to replace it.
It's not inflationary because the economy shutting down means that there's so much capital not being either moved or produced, because production is completely gone, that anything that you said that the Fed could throw at this, they couldn't move it. It's like trying to move a 500-ton beast, with a shovel, with I don't know. It's trying to just move mountains with men. And it's not possible. And that's another thing that I wanted to build on really quickly is, for all we said at the beginning, there were the coronavirus, COVID was kind of the thing that really kicked off a lot of this, but it is totally exacerbating this. Absolutely. That's part of the reason why you saw oil plummet the other day, is because obviously no one's driving their cars. Factories are shutting down. No one needs oil. No one wants to store it. And so you see the prices go down. And so definitely that's another thing to be said, how COVID is contributing to this deflationary crisis. Another thing I want to kind of circle back on, by your understanding, USD is not fiat currency?
That's a tough question, because there's all these different, it's a different recipe than it's a different recipe than Bretton Woods. It's a different recipe than like a gold standard. And so it's debt-based money with a fiat attached. So it is legal tender, but that fiat does not expand to the entire globe, right? So the U.S., it's hard to explain because it is fiat in the United States, but the United States is not the end-all be-all of the global financial system. It's only 20% of the GDP of the world. So 80% of the dollar standard is outside of the U.S., and that is not fiat. That's created in the free market by the banks, by foreign banks. So the U.S. has control over the little bit of U.S., but it's still debt-based money. So when the Fed is doing all these currency swaps and things, it's always on a term. So they'll lend money on a 3-month time frame. So at interest. So that's another reason why I say that this deflation is baked into this type of system, because you create the money, but you also have interest on that. And so somebody has to default somewhere, right? Eventually, or you just keep pumping more and more and more and more money in to try to keep that from collapsing. But it'll eventually end in deflation. They can't keep up with it forever.
So one question really quickly for this distinction, between, fiat money at home, debt-based money abroad. We've seen the Fed kind of step in to provide, liquidity with dollar swap lines and step into even foreign repo markets. If the Fed's doing stuff like that, does that mean that the debt-based money in international markets is getting diluted with fiat money?
No, because it's still debt. It's on a term. So the currency
Because
swaps
it's still collateralized by something. So what makes the fiat money
has to be paid
fiat
back.
in the United States? Is it what part of it makes it fiat money? Is it when the Fed buys something and adds it to its balance sheet and the bank never pays it back?
Well, my definition here of fiat, I mean, some people can argue with this, but I say it's money created that is not have an associated debt created. So you just conjure it out of thin air, and there's no debt associated with that. So the government doesn't have to sell treasuries. They just create the money.
Yeah.
Since there's treasuries attached, those treasuries are debt, right? And so there's financial products and et cetera. That's what backs the US dollar for the most part. There is some you could find some like little pieces of fiat in the system where I think the interest paid on excess reserves at the bank, the Fed, that interest might be considered fiat, because I don't know if there's an offsetting debt with those interest payments. But I'll tell you what, QE is not. QE is definitely not fiat money. It has a debt associated with it.
But couldn't you consider that debt completely null because it's treasuries created by the United States government? Like, they can create as many treasuries as they want to. Like, if you're printing, it doesn't matter if you're printing the collateral because the money is still printed, right? I mean, sorry, I should say, if the collateral is printed, then the money should also be considered printed in fiat.
I guess there is some fiat involved with, like I said, legal tender. So anytime you slap the term legal tender on there, the court system backs it up. The common law system kind of backs up the use of that money. But debt money is different than pure fiat created by the government without any debt. And that's actually, when we go back to the modern monetary theory, that's the basis for it. Because in modern monetary theory, there is no treasury issuance. It's just, we just create the money, you guys can spend it, and the way we control the money supply is through taxation. So the input is conjured money with no debt and tax. So that's how they control the money supply in MMT world.
I don't know, what's your take on MMT? I mean, it seems kind of inevitable.
Yeah, I think that's where the central bank digital currencies are going. They're trying to create some sort of fiat power for the government, because the way the Eurodollar system are the actual monetary system that we have in the world is outside of anyone's control. It's actually it's crazy, but it's kind of free market in a way, because nobody controls the entire thing. The Fed is not central to the dollar standard, because, like I said, it's only central to 20% of it. The other 80% is completely in the wild, and there is no overarching hierarchy.
Interesting take.
When I started getting into the Eurodollar stuff, it totally flips a lot of the things that you think on your head. So it's hard to explain, and you kind of have to be exposed to it for a long time to let it
really get it. Yeah. So maybe a good thing to close out the episode. This is kind of a good place for it. You want to, unless we've already kind of gone over everything about your strong dollar thesis, but I don't know, we've kind of touched on it a little bit, but do you want to kind of talk about that for a second?
Basically, I think it's going to end in deflation, or the deflation is so baked into the cake that nothing that the government or the Fed can do can get us out of this problem. So Japanification is next, and that's where monetary policy basically has no power at all, and fiscal policy as well has no power. And this is something that I've talked to my dad about. Going back to the Japanification, he kind of calls it the restructuring of America's balance sheet, like this idea that the Fed goes in and basically just buys everything. And at that point, like you said, so for our listeners, when we're talking about the Japanification,
refers to the phenomenon it was in the 80s, right? Like the late 80s.
They're going in the third decade. Yeah.
So it's like basically just ongoing. Since then, the Bank of Japan has bought up something like 30% of equities in Japan. Like it's something actually absurd. So their balance sheet includes 30% of the stocks that originate from Japanese soil. And if like Ansel's kind of saying, the path that we're headed on is something similar.
How long can the world last with pretty much zero growth? We're not ready for that, because it doesn't sound that bad. Like it sounds, it's not negative. At least we're not going into a depression or whatever. But that's because we have lived off of hyper growth for so long, like China growing at 10, 20% every year. So there's been a lot of growth in the world. When we experience zero growth in the world, I don't think there's going to be very much political. People won't stand it. They will demand a change and some way to get growth. So that's where I think the actual monetary reset happens, whether it's to gold or to Bitcoin or something like that. And it probably won't take that long. I don't think within 5 years, they will probably start moving towards a new system.
Wow. I think that's a good place to cap it. That was awesome. Ansel, thanks so much for coming on, brother. Where can people find you?
Yeah, I'm a host of Bitcoin and Markets podcast, so you can go bitcoinandmarkets.com to find me there.
Do you have a personal Twitter?
Yep, Ansel Lindner.
Awesome.
I hope I made sense
Ansel.
here.
You did make sense, man. This was a great episode. Thanks so much for taking the time out of your quarantine days to jump on the pod. And yeah, man, we'll be keeping track of everything. So I'm gonna remind you on Twitter about your 5-year projection there.
Okay.
Set in stone, baby. No, but seriously, thanks for coming on, man. Stay well, and I hope you and your family stay safe out there.
Thanks, guys. See you.
A quick reminder that all of the content in this episode is for informational and entertainment purposes only. You should not construe the information as legal, tax, investment, financial, or any other advice. Nothing contained in this presentation constitutes a solicitation, recommendation, or offer by BTC Media, the Let's Talk Bitcoin podcast network, or any third-party service provider to buy or sell securities or any other financial instruments. Do your own research.